Hey everybody, today is September's Q&A session, so thank you to everybody that sent in a question. I really appreciate it. Today I'm rocking my Denver Broncos shirt. We're 2-0. That has not happened in a very long time, it feels like, so every win I will take. All right, so let's just go through each one of these questions. The first one is from Investing with Frank. So thank you, Frank, for sending this one in. He asks, how do you think about position sizing? What is your idea weighting of a stock? And how do you decide what percentage of capital to allocate when entering in a new position? It's a great question, and it has changed a lot for me over the last couple of years. For me, ideally I like to have 8 to 12 stocks in my portfolio. I'm willing to have up to 15 stocks under the right circumstances. Currently, right now I have 11 stocks. And how I look at my portfolio, there's 3 different tiers of stocks within my portfolio. And a tier 3 stock would be a stock that I love the company, love the business model, love the management, all that stuff. But the stock price isn't exactly where I want it to be. The margin of safety isn't, 50%, let's say. And so that's a company that I'm willing to put in about 2.5% up to 5% of my portfolio, somewhere 2.5% to 5%. A company like that would be a Sprouts Farmers Market or a Pinduoduo, for example. A tier 2 stock would be a company that I look at. I love the company. And I also love the price. It's a stock I think I'm going to get anywhere from a 19 to, let's say, like a 26% rate of return over the next several years. A company like that would be a Dropbox or maybe a Denounce Corporation or Corsair Gaming. These type of companies I'm willing to have anywhere from, say, 5% to 10% in my portfolio. Dropbox, for example, right now is close to 18% of my portfolio, but that's because I initially put in 10 to 12% and it's just shot up. But tier 1 stock, that's kind of the ultimate stock where I think I'm going to get around 30% or more rate of return. Company I absolutely love. And the only stock like that in my portfolio is Alibaba. And that type of stock, I'm willing to have 20% or more in my portfolio. But so that's kind of how I kind of divide it out. Second question I have from Emmanuel. Could you talk about the difference between hypergrowth, growth at a reasonable price, value, dividend stocks? Do you have a preference or like including combination, if not all in your portfolio? Thanks. All right, so thanks, Emmanuel, for sending this one in. So I really don't have a preference when I'm looking at stocks. I don't try purposely trying to divide out, okay, I want this many dividend stocks, this is how many hyper growth or growth stocks. I just try to find companies really kind of going back to Phil Town's model of the 4M. So management, moat, margin of safety, meaning, so I make sure I understand the business. Just trying to find high quality companies at really good prices to add to my portfolio. However, I will say that I do try not to have too much in one sector. For example, I really like Lockheed Martin right now. I think it's undervalued. At one time I had it on my portfolio and it just shot up close to my intrinsic value and I sold. But right now I have Huntington Ingalls in my portfolio. That represents about 12% of my portfolio. So I don't want to add more into that defensive sector. So I am mindful of that, but in general, I don't really try to divide my stocks between dividends, hypergrowth, and that sort of thing. So hopefully that answers the question there. In fact, dividends, I don't really care when I'm doing my valuation. If they pay dividend, great, but it's not part of my valuation process. All right, third question I have here is from Joel Pavey. He asked, are you still bullish on SFM, which is Sprouts? And yes, I'm still bullish about Sprouts. It's about 4.5% of my portfolio right now. It's one of those tier 3 stocks I mentioned before. I really like the CEO a lot, Jack Sinclair. He came from Walmart. I think he's doing a great job. I think he is really understanding the business really well. He's trying to reduce expenses, reducing the overhead, reducing the storefront size. They've really changed up their marketing. They're buying back 10% of their shares. I expect this company to grow between 12 and 15% per year going out. And right now, they're only really in the South part of the Midwest. They still have a lot of places they can grow into. And I like this company a lot. My wife and I shop there every single week, so I know it really well. So I am very bullish on the company. I personally won't buy more unless it drops down to $20 a share, which it's got in the low 22, so it's not too far off. But yeah, I'm still bullish about it. Love the company a lot. So thank you for the question there. All right, so let's go on to the next one. This is from Patrick Dillon. Let's say you do a DCF of a company, it looks good. What is your next step in researching a company? How do you look for a company? So thank you, Patrick, for sending this one in. So I will first say, if I'm doing a DCF on a company, I've already done a lot of research. That's probably my step, I don't know, 7 or 8 during the process. So when I typically look at a company, one of my first valuation process, and I haven't talked about this all that often, but I really look at earnings per share and then growth of a company. And it kind of goes back to the whole Peter Lynch valuation process. Just a quick nitty gritty, within like 10 seconds, I can determine if the company seems undervalued or not. So maybe in the future, I'll do a video on that. So I look at that, then I'll go to the company's website and kind of try to understand the business best I can. I'll look at the last earnings presentation if they have one. I'll go through their 10K. I'll go to Seeking Alpha, read articles, and then at that point, I might actually start digging into the valuation and the DCF at that point, and kind of go from there. So again, DCF is quite a bit farther down in my whole evaluating process. And again, I talk about the 4 M's for Phil Town. So I'm trying to find the meaning, the moat, management, even before I get to the margin of safety. So hopefully that kind of gives you an answer there. Next question is from Galzikin. Do you see Tencent being around in the future when there's so much crackdown on especially the gaming industry in China? And I would assume that there would be more crackdowns on personal data in Tencent social media platform WeChat? ? So thank you for sending this one in. I would say I don't know Tencent as well as Alibaba. I don't personally own Tencent. That would be one of the few companies in China I would be interested in. And I own Alibaba and Pinduoduo. That's enough for me right now. But what I'll say about Tencent, I do think there'll be more crackdowns. This is just my personal opinion, and so take it for what it's worth. But I think there's going to be more I think there's going to be more potential crackdowns from the CCP on Tencent than Alibaba. And the reason why I say that is Alibaba has some natural organic competition with JD.com and Pinduoduo and the e-commerce business. I don't think the CCP has to regulate Alibaba as much, where Tencent, I think their gaming, I think the WeChat, I think they don't really have the competition that Alibaba does. So it won't surprise me if China comes in and kind of hammers them more going in the future. However, in general, I will say that I think Tencent is a great business. Monish Pabrai has talked about that, really Alibaba and Tencent specifically, and really continue the growth of GDP in China itself. So we'll see what happens, but I would be bullish on Tencent in general, certainly if I own them. All right, next one is from Menon Loco. Do you analyze banks? If so, do you value them? So the short answer is yes. I love banks. I love financials. And I have owned Wells Fargo. I've owned Bank OZK. I'm an accountant myself, and I feel like I understand banks really, really well, and really the financial industry in general. And I bought Wells Fargo because for me personally, every company I've ever worked with has used Wells Fargo. I know from personal banking, I think JP Morgan Chase is probably number one, but from business aspect, Wells Fargo is number one, hands down. Their CEO module that they offer company is really, it's par none. There's nothing that touches it. And I actually double my money or close to that on Wells Fargo. I already sold out. I also owned Bank OZK. I was looking between Bank OZK and Western Alliance, ticker symbol WAL, and I decided to go with Bank OZK because Phil Town bought into them, and Western Alliance tripled their stock in 1 year, where I only made 90% on OZK in about a year. So go figure that one, kicking myself in that. I actually bought a bank here in the last 2 weeks. I have not talked about it. Typically in the past on my YouTube channel, I buy and I talk about it right away. I'm trying to take a different approach right now, where I'm waiting a month or two before I talk about the company. And I'm really excited about this bank. I found it from another YouTuber. So you may hear about it more in the future. And I have a whole video explaining how I value banks. And really, you can look at price to book value on a historical basis. You can look at return on equity as well. That's another good measurement for banks. So go check that out on my channel if you want to. But yeah, I love banks. Absolutely love banks, without a doubt. All right, thank you for the question. Next one is from Buji. Hopefully I said your name right. Sorry if I butchered it. Hi Justin, I'm a huge fan of your videos, really educational stuff here, but I have a few questions about the DCF, which is discounted cash flow. Currently, I'm a student trying to learn about valuation. I understand that my questions are quite technical and they may not be suited to be answered in a video, and I hope you can type out a reply. Thanks. So, all right, I'm a little scared. We'll see what these are. All right, first one is, why is your discount rate your required rate of return? Why not WACC or cost of equity? Okay, yeah. Well, okay, some technical stuff here. So I wonder if you're studying to be a CFA, a certified financial analyst. That kind of is what it sounds like. If you guys don't know, WACC is weighted average cost of capital. And, you know, I just try to make things as simplistic as possible in my models. There's another YouTube channel out there called Learn to Invest. His name is Jimmy. He does a great job breaking down WACC if you want to go check it out on his channel. And how I think of it, it's kind of a discount rate or required rate of return, or IRR, which is kind of required rate of return, but it's factoring in debt, financing, and cash of a company. And really the WACC is kind of how a lot of people talk about. That is probably the best way to factor it in. I try not to get that technical, but certainly if you want to go down that route, you certainly can. Same thing with the cost of equity. I just try to make things as simplistic as possible. But certainly there are, there's definitely an argument to be made. Those are better than just using it just a strictly IRR or discount rate there. So that would be kind of my answer there. Next one is, why do you use free cash flow and not free cash flow to firm/equity? What is generally used in industry? Okay, we got another technical question here. So, boy, I'm doing this from memory, so hopefully I don't screw this up. But so free cash flow just within itself is operating or cash from operations minus CapEx. And the standard free cash flow is looking at net income as the basis and then taking out non-cash adjustments to there and then subtracting out CapEx. Now, where the free cash flow to firm is looking at things a little differently. It's looking, I'm doing this from memory, so if I get this right, but I think it's from EBIT, which is earnings before interest and taxes, and then taking out the non-cash adjustments from there. For me personally, and this is just a personal opinion, I don't really like EBIT or EBITDA. I know a lot of financial analysts talk about that. I've heard a lot of YouTubers talking about it, but I personally just don't like using EBITDA or EBIT. It's just a personal opinion of mine. Certainly, if you wanted to use that free cash flow firm or equity, again, that's just personal basis. And I think if you're consistent with what you do, I think you're going to be fine there. And I think you probably get close to the same answer anyway. So I just try to keep it as simple as possible. So standard free cash flow is good for me. All right, hopefully that answers your question. Next one is, what are your thoughts on using a Gordon growth perpetual growth model for terminal value instead of a simple PE multiple? Wow. So going back to my discounted free cash flow model, when I use my multiple in there, I'm just basically assuming what I think is going to be the PE value going into the future, and that's just price to earnings. And again, that kind of goes back to net income, where again, I'm doing this from memory, so hopefully I get this correct. But for terminal value, for example, I believe you're using EBIT or EBITDA again. And again, I would rather use net income personally, because that factors in depreciation, amortization, other non-cash adjustments in the income statement itself that are in there. I think depreciation, amortization is a cost. Even Warren Buffett talks about that. So for me personally, I just like using the PE for my multiple on that. And again, if you want to use a terminal value, you can certainly do that. Now, as far as you're talking about Gordon growth, which is perpetual growth, I'm not too privy to that. I'm not sure what that is. I would have to do some research. But offhand, I'm not sure what that is. Perpetual kind of sounds like maybe that's kind of like a linear type growth. I'm not sure. So I can't really speak to that. I'll have to do some research and maybe get back to you on that one. All right, so thanks for sending those in. Those were interesting, fun to answer. Hopefully I answered those pretty well. Akash Desi, hopefully I said your name right. Can you analyze Sage stock? So I think Sage stock is a pharmaceutical company, if I remember correctly. If it is that, I don't analyze pharmaceutical companies. I have tried, and I just have learned it's just not my circle of competence. The only two companies I've ever looked into that I'd be willing to buy into that are considered pharmaceutical would be Biogen and Bristol Myers. And the only reason I would even buy into those companies because of from the historical standpoint, they've been around for a long time. They have a long history, good management, and that would just really just flying on that seat and not really understanding it. So, and neither one of those I've actually bought into. So I'll have to pass on Sage. Sorry, but just not my circle of competence. I don't think I could give a very good opinion of that company. But thank you for asking about it. Next one is Matthias Roca. When the correction comes, will investing in the VIX be a good bet? So if you guys don't know what the VIX is, VIX, that's a volatility index. So I'm assuming your question is, as far as maybe investing in a VIX ETF, which is exchange traded fund, something like that. For me personally, I this is not my circle of competence here. I've done some research on it in the past. My problem with putting money into those, I don't typically put money into ETFs. I put money into equities personally. And with the VIX, it's really hard for me to get my head around. Just because when I looked into it, there's a lot of different VIX ETFs, and some of them are short-term, some are long-term, some are looking at the next 30-day contract and trying to figure out what the stock market is going to do in the next 30 days. So for me personally, it's very confusing, and if I don't understand it, I just don't invest in it. So it might be a good investment. I just don't know. That one's just not my circle of competence. So sorry, I can't really answer that one too well. Eric777, he asks, how much do you recommend as a down payment for a single family home rental? I've heard anywhere from as little as possible to 100%. Thanks. All right, Eric. So this is just my personal opinion. I obviously, 100% down would be the best for a rental, obviously. I would say if you're buying a rental property, and this is not something I've done, but I would certainly want to pay at least put 20% down because you want to avoid PMI. I know there are some conventional loans you could put down 10% or 15% and avoid the PMI. I think for me personally, I would want as big of an emergency fund as possible. I'd want to have at least a year's worth of mortgage payments in my bank, and probably have another 10 grand on top of that in case if something goes wrong with the house that you need to repair. So I'm just very risk averse personally. I think real estate can be an absolutely great investment. I don't know about now. It seems like housing prices are so high. This may be one of the worst times to actually invest in real estate. But certainly if you're going to do that and do a rental property, I would just have a big chunk of change set aside that you'd be okay if you don't have a renter in there for 6 months to a year for whatever reason, and having money on the side too in case something needs to be repaired, whether it's a roof or water heater or whatever. That'd just be kind of my opinion. If you go that direction, good luck. Hopefully it works well for you. All right, next question is from TTAM. How do you evaluate a stock from a qualitative perspective? What's some of the key factors for a compelling growth story in your opinion? So for me personally, whether it's a growth company or it's a cyclical, whether whatever it might be, there's different companies that are out there. Like Sprouts is a growth company, Turtle Beach is a cyclical type company, a Walgreens may be a rebound company or turnaround play. No matter what, I'm always looking at the 4 M's, going back to Phil Town's philosophy. Make sure I understand the meaning, understand the moat, management, margin of safety. And for a high growth company that you're looking into, maybe that's really small, I think the two most important things are management and moat. You got to make sure the company has a very, very good competitive advantage where other companies can't come in there and just take away their share from their sector or industry very easily. And certainly a management team that hopefully is founder led, that knows what they're doing, and they have some really good big hairy goals that are out there that are achievable. So those are things that I really look at personally, but going back to those 4 M's is very, very, very important. So thank you for the question. Next one is from Andrew Latender. Thank you, Andrew. Your question is, have you sold more 2022 puts on Sprouts? Those premiums look very juicy right now. Also, who's your favorite investor of all time and why? So when I sell put options, and I've done multiple videos on my channel about those, I typically look for expiration dates that are 30 to 60 days out. In fact, my favorite ones are 45 days out. Those are the ones I really look for if that's possible. I don't like to go beyond 60 days because there's just more volatility with that, and I don't like having my money locked up during that time. Obviously, with puts, you could actually buy those out if you want to, but I try to stay in that 30 to 60 day range. It's very rare for me to go beyond that. Personally, but and I did actually look into puts probably about 2 weeks ago for Sprouts, going into 2022 just to look at them, even 2023, and I'm not really like the premiums for Sprouts. I think I was getting around 18 to 20% rate of return per year, which is right in the wheelhouse. But there have been so many other companies that I've been able to put puts on that I just got crazy returns. So Corsair, I think I've got around 63% on average of rate of return, for example, for puts. So right now I'm good with the 4.5% for Sprouts in my portfolio. I would rather buy if it got down to 20 at this point, but certainly we'll kind of see where things go, and I do like Sprouts. As far as my favorite investor of all time, that one's really hard. I have a lot of investors that I follow that I like, from Monish Pabrai, Phil Towns, Howard Marks is another one I like, Peter Lynch. One that really strikes a chord with me, that every single investment that he makes and kind of his investing philosophy and strategies that rings home with me, is Guy Spear. He invests a lot in financials, and he tends to hang on stocks for a long time, maybe too long at times. But for him, things just resonate with me with him and the stocks he buys into. But I wouldn't say there's certainly one more than any of those that are out there. I like to take all those and follow all of those guys and try to learn as much as I can, and kind of take in my wheelhouse and try to develop my own philosophies and strategies. But thank you so much for that question. I really do appreciate it. All right, next one is from Derek. You talked about this tiny company called Voxtur. So Voxtur Analytics, do you still follow it, and what do you think about the company? So I do follow it. I never bought into Voxtur. It's a tiny company. Last time I looked, at around $350 million market cap. They're out in Canada. They're very unique. I really like the CEO a lot. He bought the company a couple of years back. And it's a company that is in the real estate arena. They actually have developed software to help people to go in there and figure out pricing for real estate very quickly. In fact, they talk about appraisers being able to do multiple appraisals in one single day, instead of just being able to do one in one day. It takes them a long time to put their reports together. With their software, they can, and I'm doing this from memory, so hopefully I don't get it wrong, but it's more than like 10 appraisals in a single day using their software system. So it could really change the world, change the US, change Canada going forward. So it's definitely one I'm keeping my radar, still following to see what they're doing. And it's very interesting, very interesting. So thank you for that question. All right, the next question I have here is from Eel. Where do you find stocks to put on your radar and analyze? So thanks, Eel, for this question. Great question. For me, I look at a couple different places. The Magic Formula List is certainly one of those. It's developed by Joel Greenblatt, who is a super investor that I closely follow as well. And it's a free website that you can go to, and it's looking at ROIC, and it's looking at earnings yield over the last 12 months and ranking the companies. So that is a great place that you can go to. I periodically go there. Turtle Beach, Tupperware are both companies that I have personally invested in that I found on that website. I've certainly found other companies that have garnered my interest. So definitely check that out. Value Investors Club is another website that I go to. That's a free website. That I usually find stocks maybe somewhere else, and then I go to that website and then see if anyone's done a write-up on them. Micron is certainly one of those companies I read a couple different articles on that found really intriguing, that helped me buy into the company. So that's certainly a place you could go to. Another one would be Dataroma. Super investors, it basically tracks super investors and what they're buying and selling and what their current portfolio is. And for me personally, I'm a shameless cloner. 90% of the stocks I personally have in my portfolio, I've gotten from somebody else, whether it's a super investor or a YouTuber. That'd be another place that I go as well. But certainly, and super investors are a great place to follow, especially if there's super investors that you really like that are buying stocks, or maybe one particular stock they're buying a lot of. Might be worthwhile to look into. And for YouTube, there's certainly people that I follow that I trust have similar investing strategies that I've got stock ideas from, doing research on, and buying into those companies. So those are different ones. Not to say that I may not be on Seeking Alpha looking at stocks, or CNBC or Yahoo Finance, but those four primarily places that I find stocks overall. So thank you, Eel. Appreciate that. Next one is from Dark Knight. He asks, is it okay to invest in companies with negative shareholder equity? And why do some companies have negative shareholder equity? So great question. I actually came out with a video here in the last couple days that talks about book value and explains it, and that's what equity is. So I would encourage you to go watch that video. Hopefully that might answer some of these questions here. And I would say in general, if a company has negative shareholder equity, that is a red flag, but I wouldn't say you should dismiss it completely. You need to figure out what's kind of going on. Now, equity can decrease over time if companies are buying back shares, if they're paying for dividends, for example, which are good things. But if a company has a negative shareholder equity, what that means is, keep in mind that equity is part of the balance sheet, and the balance sheet is assets equals liabilities plus equity. So if equity is negative, that's a huge indication that liabilities is really, really high on the balance sheet. So it could mean that they don't have enough cash on hand to pay for their debt. So I would look at other parts of their balance sheet. I look at cash, see what that looks like. I would look at the short-term debt. I would look at long-term debt. If the company has negative equity, I would go and read up on earnings presentations, 10Ks, see if the company talks about the equity situation, how they're rectifying it, how to increase it going forward. But certainly, again, it's not something you should completely dismiss. It just means you need to do more research, but certainly a red flag overall. And I'm kind of kicking myself from a video I did here about 6 weeks ago on Lowe's. I did a stock analysis video, and I talked about their equity dropping and said that could be a red flag, and I'd be concerned potentially about it. And someone said, hey, Justin, you didn't see that the company's buying back shares. That's why the equity is going down. I was like, I'm an accountant. I didn't even look at that piece of it, but that was why their equity is going down so much, because they're buying so much shares back because they have so much free cash flow. So again, it's just important to do your full due diligence to see what kind of going on there. But great question there, and definitely go check out that video on book value that I put out. That may be helpful. Next question is from Flint. He said, I like to see how to evaluate a company using metrics other than like cash flow, for example, using EBIT, EBITDA, sales, earnings per share. Sometimes it doesn't make sense to use cash flow. I think about a company that has a lot of capex, like for example, Amazon, that has a lot of growing EPS. So great question. So absolutely correct. By looking at companies, and maybe free cash flow doesn't make sense as far as doing a valuation that way. One that comes to mind specifically for me that I have bought into is Micron. So they have a ton of capex. And if you do a free cash flow projection, it's just not going to make any sense whatsoever. Cameron Stewart is another YouTuber where he was looking at that, and he's like, doesn't make sense to invest in this company, no free cash flow. However, when I looked at the company, I'm looking at earnings per share, which is like 3 over the last trailing 12 months. I'm looking at their earnings, their sales over the next year. And for my projection, the EPS should be between 10 and 15 by the end of 2022. And if that's the case, the stock price, in my opinion, should be well into the 100s. It could be anywhere from 150 to 200. That's just my personal opinion. Make sure to do your own research on that. And so a free cash flow valuation doesn't make sense in that particular case. I actually kind of just use a quick valuation using Peter Lynch's strategy of looking at EPS and growth rates and project out to see what the stock price should be. So certainly it makes sense potentially not doing a discounted free cash flow in some reasons. And cyclicals, turnaround plays, using a free cash flow may not make sense there as well. So you kind of have to look at the company and see what what makes sense. So yeah, I do agree free cash flow doesn't make sense in every single with every single company, but I will say in general, the net present value of the stock price, what a company is worth, is all future free cash flow discounted back today. But certainly using other metrics may make sense. For me personally, I stay away from EBIT and EBITDA, but as long as you're being consistent on your valuation strategies, you should do fine there. All right. So, and something I should add too is if you looked at my video from Danaus Corporation, I talked about NAV, which is net asset value, which is similar to book value. I've also talked about in other videos when I'm looking at banks, even this video as well too, looking at price to book or book value. So certainly again, not talking about free cash flow and looking at discounted free cash flow model. So there are different other valuations out there that might make sense. So good question. Appreciate it, Flint. Next question is from Scott North Music. So Scott, I did get your email. I haven't responded to it. I will, I promise you. His question is, how do you find a business's equity growth rate to do an analysis? Don't we want to use the equity growth rate to help find the sticker price? I've heard people say, equity, is really the fair value of a company. You should be using equity as potentially growth rates. And like I said in this video, you got to be careful because companies can manipulate equity easier than they can manipulate free cash flow. Not that free cash flow can't be manipulated. It certainly can. I would say you got to be careful with equity. When I'm looking at companies and you look at most of my stock analysis that I do, I'm looking at 4 different growth metrics. So I'm looking at sales, I'm looking at earnings, I'm looking at free cash flow, and I'm looking at book value or equity of a company, and looking at those 4 and seeing if they're in line or not with each other. If one is growing a lot more than another, or one's not growing as much as another, that could be a red flag I need to dig into. But certainly equity is an important piece of a company and seeing how it's growing compared to those other factors that are out there. But certainly the growth rate of equity, I'm personally looking, if I'm looking at free cash flow, I'm looking at free cash flow of the business historically and what I think free cash flow is going to be going into the future. But certainly, again, it kind of goes back to your philosophy of being consistent. If you're being consistent in your philosophy, it's okay, but just understand equity can be manipulated more than free cash flow. So it may or may not be the best value to use, in my personal opinion. So thank you, everybody submitted a question. I had no questions. It'd be a pretty boring video overall. So thank you so much. Hopefully you got some value out of this. If you did, smash that thumbs up button on the way out. If you haven't subscribed, think about subscribing. Love to have you join the team here. Thank you so much for watching. I'll catch you guys on the other team. Go Broncos. Take care.